Hello guys, welcome back to Zodiac Trading. So yesterday I made a video about the what went wrong with the SVB bank, and today I'm going to talk about more of the bailout, and I'm going to start looking at the Federal Reserve and also the Treasury, their and FDIC's joint statement, and then I'm going to talk about a little bit of the risk management of SVB because and then in the final part, I'm going to cover a little bit of the uh, the significant moral hazard and also the conflict of interest behind all this. Because from my point of view, this is a bailout. Okay, let me just be clear because a lot of people have been saying this is not a bailout. For example, I was looking at the Bill Ackman statement about how this is not a bailout because it's not using the taxpayers' money, but essentially you are doing, pretty much the same thing. Because instead of using the taxpayers' money, what you have done is you actually use the bank's clients' money, which basically the same because they are essentially taxpayers. So you're using your money to bail out. You're using that 100 billion reserve inside the FDIC, and you're providing $25 billion to bail out the SVB. Of course, and Bill Ackman been saying, and I was, reading these Washington Post kind of bullshit, something like, um, you're basically the SVB Senior Management Board and also the equity holders are being punished and they're being wiped out. Okay, and the fact that all these people, uh, the CEO and all the senior executives managed to sell off their stocks and also their equities shortly before this entire tragic happened, shortly before this bank run actually happened, and these people already pocketed. We're talking about millions of dollars in cash saved. So they have all the money to pay for the lawyer costs. And what they're going to do is, well, definitely they're not going to get their job, probably, 1 year or two. But then they probably be hired as a independent kind of consultant, for another career. So I don't mean, is that any kind of punishment for a bank run like this level? So by bailing these bank out, even though you're not using the taxpayers' money, you're using the bank's clients' money, and you are encouraging people to take massive risk. You're encouraging people to take massive leverage, and you're encouraging the senior, uh, and also the CEOs to ignore risk, and they can just do whatever they want because they can always expect people to bail them out. So call this whatever you want. It is a bailout. Probably not using someone's money, but essentially you provide a net for the depositors. You let them escape from a punishment. Okay, some people may argue the depositors are innocent, but the fact that these so-called innocent institutional investors, because let's just face the fact, SVB has more than 90% of their accounts, more than 20, 205,000 $500,000, and they're supposed to they are regulated by FRS, and also they are institutions that really have brain intelligence to make the least judgment out of SVB. And I have been asking around for several clients in SVB. They have the SVB provided a very crappy service, and as I will mention in the end of the video. But now let's just look at the Federal Reserve and what they're going to do with these bailouts. So basically, what we can see is here. This is a joint statement by Treasury, Federal Reserve, and FDIC. So that kinds of for me, it raised a very important question: is that are you going to bail every single banks out of this if you're raising interest rate and then banks are having problems. So today you're bailing, uh, let's say SVB out. Are you going to bail out also the Silvergate? And possibly if Credit Suisse would have bankrupt, are you going to help save Credit Suisse as well? So that definitely gives us a warning sign, because what the Federal Reserve been doing here and now, I don't think that is any, I don't think it's legit at all. So they're just saying, okay, these statements just saying a bunch of crap, and then I just say we will make available additional funding to, basically they're going to provide hundreds of billions of dollar as, I would just say, a loan, a structured loan to SVB. So SVB could exist like a zombie, and right now the senior management board, I have no idea if they are they being, sued by their investors or whatever, and I have no idea what's going to happen. And you have these SVB company left, but then it has a decreased value portfolio. And on the other hand, a lot of banks, a lot of big banks are looking forward to pay for whatever left over from SVB, because, oh, come on, I just face a fact. The SVB has quite a good amount of good assets. So a lot of people saying, oh, we should bail out SVB because SVB was, operating, and it has, good and valuable assets, still worth something. If you just bankrupt the bank, you end up having nothing. So we're adults. We're here because one of the lessons when you grow up is that you have to take the consequences, the full responsibility for what you have done. But now clearly these depositors are not, and also the equity holders are not, paying the prices. And I think the Federal Reserve is providing them with a structured loan, so other big banks and larger entity could just buy out these assets in cheap price, as long as they are solvent of paying off their debt, and also be able to turn these assets somehow profitable. And then let's just look at some of the interesting stuff that I'm looking at. So here, this is this guy called Alf. He says SVB does not deserve a bailout because they are doing really bad at risk management. And I want to start from here and to explain briefly of what really happens inside of the SVB risk management system. So during 2020, SVB started to have and raised lots of assets. Okay, so you have a lot of people, because that's a low interest rate environment, and Biden administration decided to inject a lot of liquidity inside the financial market. It decides to bring a lot of more of input inflation and also monetary policy to save the economy. So as a result, you have very cheap money flowing around in the financial market, and all these VCs and all these institutions, they have a lot of investors put their money inside of all these institutions. They have nowhere else to put this money, so they decided to pile all this money inside of SVB. So the business model, as I have mentioned in a previous video, it was very simple business. So you just make the loan to the bank. You make loans to the startup companies, because the startup companies clearly they are not going to get any commercial loans from traditional banks. So you decided to make loans to them, and then once you have that amount of money injected to your balance sheet, you don't know what to do with that, right? So it turns out the brilliant mind of the CEO and also the management of SVB, how they actually solve the problem is that they put all this money to buy bonds and to buy long dated bonds and asset backed securities, and we're talking about you know, hold to maturity kind of assets. These type of assets lacks of liquidity. You put the money in, you kind of lock up for 1 year, 2 year, and then you're going to get maybe 1 or 2% out of yield. And if you're not holding to that period, you don't have that yield, you don't have that payment, you don't have that profit. So instead of making these huge amount of money as loan and lending these money to the unicorn business as they have promised, they instead of that they put most of their portfolio inside of the bonds. On top of that, they are fully aware of the Fed is rising interest rate. And then they decided somehow brilliantly that they are going to long these assets. They're going to buy these assets without putting a hedge. So they are naked or whatsoever. I think in their Risk 101 book, that actually doesn't mention about anything about hedge or anything about options or bond futures. The fact that they are not buying any hedges creates dramatic losses because the inflation is skyrocketing, and then Fed is continuously rising the interest rate. And then, even though Federal Reserve managed to tell the market what exactly they're going to do to trying to help the financial market be well prepared of the rising interest rate environment, but still, SVB didn't do any sort of preparation. They didn't do any kind of risk management. They just long the bonds. So what happened with the bonds is the bond yield goes up and the bond price is plummeted. So they are losing a lot of money on the book value. So their some of their key and big depositors are not very happy and not very satisfied with the fact that they are creating all these losses. And then what happened next is again on top of the brilliant mistake that you know betting on bond huge without adding any of the interest rate swap or any kind of interest rate hedges, they trying to raise money out of their equity. They're trying to collateralize their shares, and they're trying to raise additional money to compensate for their losses in the bond position. So that's kind of hilarious. That's if you're doing that publicly, that's like telling everyone that your bank is insolvent, that your bank has some big problem, that you have to sell your shares, you have to raise other capital to do that. So that would be, that is hilarious. So on top of that, they messed up again. Some of the key investors and also the depositors decided to move their money out of SVB. They're extremely concerned about the safety of their portfolio, and then they decided to put the money elsewhere. That triggered a bailout. That triggered no no that triggered the entire bank run because um, they tried to withdraw $52 billion out of the banking system, but they couldn't. All right, so they couldn't. The fact that they couldn't get this money out of the SVB actually raised a lot of concern, and the rumor spreads out. More people are trying to take out cash, and then what happened with SVB is that they are tied and locked up with all these long-dated securities and bonds because they are so lazy. They didn't have the time to lend this money out, and even if you try to manage to lend out this money to unicorns, most of the unicorn companies and startups are not profitable during 2020 and etc. A lot of startup businesses are struggling. They're extremely difficult to get IPO, extremely difficult to get any growth. So it's not really kind of profitable to make any money. So they decided they would put money in the bonds. So then they got locked up. They have to sell their bonds. They have to sell their ASF. They have to sell their assets, and then that created losses again from their balance sheet. What happened next is most people pile up their money and get out, and then leaving the SVB dying And then couple days later, I mean, maybe like 48 hours later, the bank declare bankruptcy, and then Fed step in and saying, "Oh, hey, we're not going to bail this out." And then when the reporter and journalists ask of the details if they're going to bail this out, they're trying to say the word bail out without using the actual word bail out, because by definition, the Fed's definition and also the Biden administration of bailout is that you don't use taxpayers' money, but you're allowed to use bank clients' money. You're allowed to use the profit from the banks, so-called the member bank of FDIC. So you're free to use the money to compensate the depositors. They don't have to take consequences of their failure and of their poor risk management skills. And also, most of them are professional investors. You know that it's very ironic that you find out most of the people in the financial industry, you're not as sound and smart as they as they look. So that creates a paradox. So what happened is, I believe this bailout is it's an ugly one. It is a bailout, and it creates significant moral hazard because, first of all, if you are bailing SVB, are you going to bail out other banks as well? And second of all, is that by bailing out and without using the word bailout, you're using the client's money, and then that just encourage that's like giving the green light to other banks that you're free to go without hedges. You're free because we are going to pay you. You're going to be safe. And the banks would probably be doing that again and again. And next time, probably it's not SVB, maybe the other bank at a larger scale, because we all know this inflation problem still exists. If it still exists, we still need to raise interest rate. So if we raise interest rate and other banks are not following, other banks will have the same problem sooner or later. And the third is that right now the FDC has already used a quarter of their reserve. They're using 25 billion out of 100 billion. They're using 25 billion for credit protection to give the depositors confidence, so they will just remain the same. And so everyone from SVB just need to pretend nothing has happened. So if that just asks a question, if you're a client of SVB, and then after all this, the moment when you notice that your money is safe, what will you do? Of course, you're going to withdraw that bloody money out of the SVB, and then you're going to put the money elsewhere. That's what you're going to do. But now, instead of letting people bearing their consequences, they're trying to calm these clients and trying to tell them, do not move this money to other banks, and then pretend nothing has happened, which is against human nature. So I think it all turns out, in the end, people will still put the money to other banks, not SVB. It will create obstacles for SVB to continuously be profitable. And then this money will probably move to other big four bank, which is backed by, billions of dollars, hundreds of billions of dollars of the taxpayers of the entire system. They'll put the money elsewhere, and then that will concentrate the risk. And then the entire financial market will become another hot pot. Again, they will become another big bomb, time bomb. And the fourth, and which is the last thing, is that by doing this, you're creating that if you're not bailing everyone out, and then I mean, if depositors can get all this money back, and then what happened if you're investing in a stock, or say penny stock, all right? And a lot of people actually deposit their money in FTX as well. What are you going to do with that, right? They're also depositors by legal meaning. But then FTX depositors are not going to be paid full. They need to hire a so-called specialist, pay him thousands of dollars per hour, so they could have hope getting some of their money back. But then here you are giving all free money from the FDIC, bailing out the depositors at no cost. Okay, and the entire policy is joke for me. It's a bailout without saying the word bailout. It's perhaps one of the ugliest bailout in the textbook of history. And I think Bill Ackman and other people, other investors, will be blamed forever for this because they are using double standard. They're being hypocrite by not by by not addressing the fact the essence of bailout. If you can say, okay, the SVB as a company is not bailout. We are not like bailing out the CEOs. We are not bailing out the equity holder, but we are encouraging risk, huge, larger risk by tolerating people ignoring risk management. So I think it's very sad to see, the whole thing, the SVB thing has gone to the toilet. And I believe, as we can see from yesterday's market opening, the entire financial market are not, really confident, not really convinced by these bailout. So people are still having questions. A lot of people are just, simply debating whether the fact that if this is a bailout or not. And then Washington Post and a lot of people keep saying it is a bailout. That just makes the entire thing very shady. So it's kind of that you just kind of playing around the legislation, you playing around with the legal terms, but it is a bailout. So thank you guys for watching. I'll see you in the next episode. If you like my content, please subscribe and click that like button for me, and so I can, share more of the valuable insights and content for you guys. See you in next episode.